My name is Lamont Mackley. I am an associate here at Jumpstart, and I certainly want to welcome you to how to prepare a financial forecast. We are prepared to take you through a learning experience, to give you some insight, to share some of the backroom insights concerning financial forecasting, concerning what's on the minds of investors or bankers. And I'm hoping that you take full advantage of this great panel that we have to present to you this evening. Our hope is that at the end of this night that you will have a degree, if you will, in financial forecasting. We want to make you a financial forecasting master. That's what our objective is, so that you'll know what you need to know about financial forecasting, and you will know what you need to know about what's in the mind of the investors and what's in the mind of the banker. And that will hopefully make you more effective in dealing with the audience of financial affairs. So let's get started with this evening. I want to introduce to you the first panel who are going to present to you. Let me introduce to you Jerry France. Jerry France is the managing partner in entrepreneurial services and investment partner here at Jumpstart. Jerry manages a team that provides Jumpstart portfolio companies with guidance and resources to help them grow rapidly. Jerry's experience is in advertising, it's in marketing, and it's in brand management. But he's also been an entrepreneur. In fact, Jerry was a member of a management team that launched the venture-backed Classic Sports Network, now ESPN Classic. Jerry's entrepreneurial experience also includes serving as president of a startup that partnered with Nickelodeon to launch a line of beverages for kids. Now, Jerry has another distinguishing honor. He was actually one of the founding members of the team that started Jumpstart in 2004. And he started out as an entrepreneur in residence here at Jumpstart. All right. Larry Evans is president of L.J. Evans and Company. He is a CPA. And Larry helps clients achieve financial goals by providing outsourced accounting. He's a CFO. He becomes a CFO and tax services for small and medium-sized businesses. He's worked with many, many companies in all types of industries, focusing particularly on entrepreneurial startups and technology companies. Larry has assisted businesses in business planning, financing, mergers, acquisitions, and providing them with all the accounting and tax services that they need. Larry also is a mentor with Bizdom here in Cleveland, providing his expertise on cash flow, financial forecasting, and accounting services. Would you help me welcome Larry, please? Thank you. Larry Evans, thank you. All right. Okay, with that, Jerry and Larry, it's your turn.
Thanks, Lamont. Overall, the agenda today, I'm going to spend a minute or two on Jumpstart just to set some context for you. We'll talk a little bit about why financial forecasting as a process is important. And then we'll go through a couple of sequence of topics. First, let's talk about building the model. What are the tools you need to do to actually build your forecast? Then once the tool's built, how do you create your forecast and make your projections? Going through assessing the work that you do, and then we'll talk about some guiding principles and resources for you. So we'll just be clipping along. To start, if you're not familiar with Jumpstart, Jumpstart is an economic development organization. As Lamont mentioned, we were founded back in 2004. Our mission is to strengthen the economic vitality of Northeast Ohio and the U.S. by helping communities realize their entrepreneurial potential. So clearly the key theme there is helping entrepreneurs where there's potential, and with our services and access to capital, let them become the growth companies that we believe they can be. Starting back in 2004, the main client companies that we worked with, if you may know, was more what we'd call the traditional startup company, the venture capital track. So those and the support we get through the Ohio Third Frontier program is how that funding has happened largely. So that's looking at companies that are technology-based, that are early stage, maybe a handful of employees, maybe just a founder, seeking big market opportunities for growth to become scalable and going down a path where they may get equity investment from venture capital. So the Silicon Valley classic model. Over time, we've been expanding, and we're expanding into what we call scale-ups, which is small business, because there's tremendous potential, going back to our mission theme, amongst companies that aren't necessarily high-tech, but are high growth. Companies that could be anywhere between, say, 4 and 99 employees, have some recurring revenue and so forth, anything that can generate impact. Why are forecasts important? Well, there's a couple of main themes. First of all, if you're just starting out, or if you're making the classic pivot, or if you're trying to grow, you want to have a way to assess the feasibility of your model. Is it something that's workable? Is it something that's going to be sustainable over time? Second thing is, a financial forecast can help you identify the cash that you need and the fundraising needs. On paper, as we'll point out some of the themes that we'll see, the trajectory of a company may work, but you have to get cash up front. Cash flow and profitability aren't necessarily the same thing, so understanding when you need to get cash and how much is important. And also using those tools can help you as part of the sales process to the fundraiser. And third, managing operations. One of the themes that will hopefully come through here is the financial model and financial forecast. It's like the vital signs chart. It's like it's the patient's portfolio. Looking at a financial forecast should be just like looking at the vital signs of a patient to assess that patient's health. So it's really a representation of the health and potential of the business, and financial models, although they appear as numbers, should really tell a story and help the founders and management team understand business choices. It is a business cycle, so one of the things that's also part of this is the financial modeling process continues somewhat in perpetuity. You begin with your forecast, you execute against that forecast, you want to first set your business model, understand your budgeting and so forth, execute to deliver against that, measure and report on how you're doing. That reporting, as we all know, you got to report to the government for taxes, you got to report to your investors for how you're doing if they want a return, and you got to report to yourself to see how you're tracking versus projections. How frequently to cycle depends on the industry. When I was in one of my startups, I recast my numbers, and sometimes weekly, just constantly looking at new information, because when you get into a cash crunch, you want to stay on top of the business. Other times when things are more predictable, you back off of that. So it varies based on stage and based on the type of company that you're in. The first key piece of the financial forecasting process is you have to have the right tools and you have to have the model. And the three components of that model, the fundamental pieces are the income statement, the balance sheet, and the cash flow statement. And the most important word on that slide is in the subhead. They are integrated documents. They work together, and one of the things that we'll show as we go through this is how they interact with one another and how that helps you understand and manage what the forecasts are telling you. So I'm going to turn it over to Larry. What we're going to do is go through the components of the model. We'll then, as I said, we'll talk a little bit about how the forecast gets put together, and then we're going to pop out a PowerPoint and go into an actual spreadsheet and kind of tour around in there and give a live example of how these things work. So, Larry.
Thank you, Jerry. The other key element that you'll want to put together, it's not actually part of the financial statements or the actual forecast itself, but if you are ever trying to raise money from a venture capital firm or an investor, they'll want to know what your assumptions are. And it also helps you as you get into the process of actually crunching the numbers and doing the statements and the forecasts to know what your assumptions are. And for example, how many click-throughs if you're on a website selling XYZ, whatever it may be, how many clicks do you need to generate customers, and how many of those are actually going to buy, and how many are going to be repeat customers and things like that. All of those sorts of assumptions are going to flow into your pricing, your revenue model, and your expense model. So it's not, again, a part of that, but I would definitely document your assumptions very, very carefully. And they'll change, too, over time. We're talking first about the income statement here. This is the statement. Most people are probably most familiar with the income statement. You can see there it's just kind of going through the revenue and the expenses. One thing I'd point out here is when you're thinking about accounting and doing forecasting, the method of accounting that you probably should be using is generally accepted accounting principles, which is also referred to as GAAP. Most investors are going to want to see GAAP financial basis statements, as opposed to perhaps you're on a different method for tax purposes, maybe a cash method if you're a startup company. But the GAAP method will show you a much clearer view of where your company is. It will include things like receivables and payables and other things that don't necessarily show up in a cash basis statement. The other thing I'd point out, oh, I'm sorry, Jerry, on here is the importance of gross margin and defining what your cost of goods sold or your cost of revenue is going to be. Because the gross margin number, we'll talk about this a little bit later, is one of the key metrics that you're going to look at, that investors are going to look at to determine how strong your business is and how viable your business is going to be. And so when you come up with what those items should be in your cost of sales or your cost of goods sold, I always tell companies to take a look at companies in your field, public companies, and go into their financial statements, see what they're including in their cost of sales number, what they're including in their cost of goods sold number, and then figure out, what are the right things for you to be including. Next one we have here is the balance sheet. And for most companies, at least startup companies, this is the one that they probably think about the least. Although if you look in publicly traded company financial statements, this will be the first one that you see in the package of financial statements because it's generally viewed as the one that shows the health of the company at any one point in time. Very simply, it's assets equal liabilities plus equity, and your assets are listed there as well as your liabilities and your equity. The one thing there I point out too is goodwill and intangibles. For a lot of startup companies, you'll be investing a lot of money, perhaps in research and development, and those amounts are generally going to be expensed. So they're not going to show up as an asset on your financial statements. They're going to go through your P&L and they'll end up in your retained earnings. And so sometimes your assets look kind of thin, especially if you're a startup company, if you're a software company. You've got some computers, some printers, some other things like that, and maybe some cash and receivables, hopefully. But you're not going to have a lot of assets necessarily.
Just one other thing that's important to note, it is point in time, so it's showing at whatever point that statement, how much cash, what does the company owe, what are receivables, so that's showing more that macro picture of economic health. That's what that statement. The interesting thing about the income statement is it shows, are you making money on paper? On paper. I sold this much this month, it should cost this much, and here are all my expenses, and boom, did I make profit on paper? But it doesn't talk about whether the cash is flowing in or out. It's just lining up that statement. When I started my career in Bristol Myers Squibb, working for a huge company, all we looked at was profit and loss statements, income statements. Is the brand making money on paper? Because we didn't worry about cash flow and balance sheet. That was handled at the corporate level. But you'll see when we start moving forward, it's a little different picture when you start looking at cash flow as a startup.
Right, which takes us into our next statement, the cash flow statement. And this is a critical one for startup companies because it's going to show you how much cash you're generating from operations, how much cash you're generating from investment activities, and how much cash you're generating from finance activities. And what we'll see as we look at the model later on, when you look at, a lot of times a startup company, for example, is not going to make money, so it's going to have a cash burn element. And what the cash flow statement is going to tell you is how much is your cash burn each month. And we didn't talk about this, but we really would suggest that when you do your first projections, your first forecasts, you look at doing month by month as opposed to year by year, because you're going to have, within a year, significant variations between months many times, and you can get caught into a situation where you're short of cash in 1 month, and you need to figure out how you're going to plug that hole. So the other thing I'd point out here is that the operating activities, you generally start with your net income amount, and then you've got some non-cash items. So remember, this is cash only. So if you're using generally accepted accounting principles, you've recognized revenue for receivables. So if you bill somebody in December, but they don't pay you until January, in the income statement, that will show up as income. However, so you're starting it off here, it'll be in net income. But you haven't received the cash yet. You're not going to receive the cash until next month. So that change in assets and liabilities line there is going to show you that you have a negative $1,000 for the increase in receivables that you have. So your actual cash flow from operating activities, in my simple example, is really zero. The next month, when you collect the cash, you'll have maybe zero income, but you'll have a reduction in the receivable, and that shows up in your cash flow statement. The other point is the financing one on the bottom. A lot of people think sometimes that if they borrow funds, that's income. Borrowed funds and capital investments are not considered income. They don't go into the income statement. And likewise, when you pay them off, you don't get a deduction for them. A lot of people think, well, I paid off my line of credit, so I should get a deduction for it. The answer is no, because you've already deducted those expenses when you spent the money. This is a very detailed list of expenses. I generally suggest that you start with the expenses because they're easier to get your arms around. You'll generally have a much better idea of what your costs are going to be, at least initially, if you're starting off, because you're not going to have necessarily that many costs. We won't go through all of these here, but and the one big one that kind of funnels through all of these categories is personnel. I mean, that's going to be one of your biggest costs. And one of the things that Jerry points out here on the bottom is hire slow, fire fast, and make sure that you monitor what your costs of labor are going to be, because it's going to be one of the biggest costs in your statement.
Yeah, I think the net takeaway on that slide is be comprehensive. Think of everything. 'Cause it's really easy to say, oh, well, I have this salary and here's my rent, but all those little things add up. And when you start laying all those out, it can change a bigger picture. If you're just trying to manage your business or do a forecast sort of a back of the envelope, that's going to really be a mistake.
Yeah, absolutely. And if you saw the income statement that we showed here was pretty summarized, and that's generally how you're going to see an income statement in a publicly held company's financial statements or in any company's financials. But when you get into the forecasting, it's really, really important to be as granular as possible on every expense. How do you forecast expenses? Generally, your expenses are going to fall into one of several categories. For example, there'll be a percentage of sales, and if you're accepting credit cards, you're going to have credit card fees. So you know that that's probably going to be 2 or 3% of your sales, and that's an easy way to benchmark what those fees should be. Some things are going to be fixed monthly amounts, for example, your rent or your salaries or your payroll. So you know what that's going to be, and that's going to be fixed. It's not going to vary by sales. So you'll be able to plug that in pretty easily. Some people do a lot of percentages of other amounts. For example, they'll say my certain types of expenses are going to be 2% of my gross revenue. And that's fine if you're starting off and you don't really know what those costs are going to be, or if you want to have sort of a general miscellaneous expense category that's 1% of your sales. The thing I've seen in some statements, though, is that as they project out, that the absolute number becomes significantly higher as the sales increase. So you've probably got too much in the percentage category, so you need to kind of ramp it down over time. And some of these costs, too, as we talk about that, you're going to have much heavier costs up front for R&D, maybe for marketing as you're getting started, and those are also going to change over time. A percentage of another amount, for example, the payroll taxes, you know you're going to have to pay the Social Security, the Medicare, unemployment taxes, Bureau of Workers' Comp, all those additional sorts of taxes that are going to be on top of your payroll. And of course, if you're going to offer benefits, you need to consider health insurance, dental, life insurance, all those other kinds of benefits that you may have also in the forecast. And then there are some things that are more one-time expenses. They're cash out of pocket, but they're not necessarily expensed right away. There might be capital additions like computers. If you're in a manufacturing environment, equipment, and as well as inventory are going to go in there too. So that's the expense side. On the revenue side, it tends to be more complex, and this really gets to the heart of your business model. And this is where I see, and I really advise companies to spend a lot of time getting into your revenue forecast. And we've got some slides later on that will show the level of detail that really you should try to get to in your forecast. Because if I've seen several companies who've gone for financing, and where they really, really get grilled is on the revenue. Is it feasible that you're going to make $100,000 in 6 months? Do you really have the people necessary to do that? How are you actually going to market this and sell this and generate the revenue very quickly? This is often referred to as the sales funnel, so you want to get through that as quick as you can. It's also sometimes referred to in the accounting world as order to cash or marketing to cash. So you want to have that be as short a period as you possibly can.
Yeah, and as you look at the funnel as a classic funnel, one thing to note here is as you go through every stage, there are expenses associated with that. So building awareness is talking about advertising and outreach, and if you advertise, but what are you going to expect? How many people are going to come to your website? What's that assumption? Then when you have those prospects identified, how do you capture? What's the percentage there? What are you using to convert your customers? Can they just buy through the website? I mean, a classic error that people make with software companies is what I'd call the if you build it, they will buy syndrome. And they push out their website, we went live, and it's like crickets chirping. So, how do you convert? You have to actually have someone follow up. Is it a human cost, et cetera? And as you go through all those things from awareness building, prospect identification, converting customers, and then how do you keep them, retain, and convert them? Do they try, what percentage of your companies are going to fall off because they're going to not like your product or your service? All of those things, there's thousands of assumptions in there, but that level of granularity is the story you build and things you need to test and measure, because that's what ultimately ends up in the cash register.
Right, and you may also have different types of products. You may have a standard product, you may have a premium product, and you also have to really get into pricing when you're doing this too. And is your pricing going to be reasonable? Is it going to create enough income for you to generate a profit and make the investments and pay your expenses that you have to make? So again, I think this really gets into the heart of your business proposition, and this is where you spend an awful lot of time. And of course, you can't forget the tax man if you're profitable. The type of entity that you have is going to determine where the tax is paid, but the tax will ultimately be paid. For what we call the pass-through entities, the limited liability companies, the partnerships, and the S corporations, if you have income, it's going to actually be reported on the owner's tax returns. So you'll have to budget distributions to them to pay taxes. If it's a regular corporation, then that entity itself will pay the taxes, so you'll have to include a provision for income taxes on your income statement, which we saw before, and international taxes as well.
Okay, before we get into examples, the next stage, which we'll demonstrate a bit, is how do you assess if your forecast is working, and what we call sort of stress testing it. So one of the things when we started, we said that these three main schedules are integrated. They interact with one another, and that's the most important part of this. You build a model where you can iterate and see the impact of making changes of assumptions as you go through. So understanding, for example, what's going to happen if you are wildly successful and you have more sales, that puts certain pressures on in terms of what you need to do for inventory costs and so forth. What happens if your cost of goods are too high or too low? What happens if you don't sell? All those things are things to look through. So it's helpful to build aggressive schedules. If things go really, really right, that creates some high-class problems, like, oh my gosh, I got to staff up for more customer service and so forth, but also to look at what happens if things don't go so well. So, and ultimately, especially if you're a startup or an early stage business, or if you're trying something new, a pivot, or trying to do something new with your business, ultimately you want to make sure that the bottom line is, can your business survive if things don't go as planned, and can you be prepared?
And there may be things that happen that are external to your business. I was thinking the other day of, with oil prices dropping, is Tesla going to be looking at its projections? Because it's valued, I think, based on the number of electric cars it's going to sell in 2020. And if people don't feel as much pain at the pump, are they going to be as anxious to buy perhaps a more expensive electric car? So it's another macro issue to take a look at and consider when you're doing your forecast. These are some of the key things that you're going to look at, and that investors or bankers or others are going to look at when they look at your company. We talked earlier about the income statement, where you've got the gross revenue less the cost of sales or the cost of goods sold to come down with your margin. And that's your gross margin. You'll hear net margin and gross margin. The net margin is, generally speaking, your after-tax margin, your bottom line profitability. Gross margin, you'll be able to get some feel for what your business model is like by looking at your margins. For example, if you're in the software business and your gross margin's only 50%, then you need to rethink your business model. Because if you look at most of the software companies or SaaS companies that are out there, you've got margins that are 70, 80% plus. So you need to figure out what it is about your particular assumptions, your pricing, your product, that you're not getting to that point. The other one I point out here is current ratio, current assets divided by current liabilities. This is a measure of your ability to pay your bills as they're coming due in the next, generally speaking, 12 months, although, I would do it month by month. Current assets are your cash, receivables, and inventory, things that you can really convert to cash relatively quickly. And then your current liabilities are things like payables, short-term debt like credit card debt perhaps, and then the current portion of any long-term debt that you may have that's also going to be payable in the next 12 months or so. Debt to equity can be important, although generally speaking this is something that's applicable to larger companies as opposed to startups or smaller companies. And it can vary widely by industry. If you look at Facebook, theirs is almost 0. IBM's is 3 to 1.
I think the ratio is, you're right with that point. If you're a startup though, just the absolute amount of debt can be a huge problem, because if you owe money, you have got loans, and you're going to go out and try to raise equity investment, it creates this tension because the equity investor wants to put money in to grow your business. They don't want to put money in to pay your debt. So that getting too much debt on the balance sheet creates a problem, and that's one of those red flags. It's like, oh my gosh, look at this, all this debt that's been accumulated. When's that due? You're trying to raise $500,000, but I have to use half of it to pay off a loan. The investor's not going to like that.
Well, the other one down there is implied valuation. That's something that comes later when you're looking at what is the company worth in 5 years or 10 years.
And I think part of this too is it's the industry norms. So whatever business you're in, and we'll touch on this a little bit later, know what's typical in your industry because you want to be aligned. If you have better margins, that's what's normal in your industry, and you can explain why, that they're all reasonable assumptions, that's a really powerful thing because that makes your business model more attractive.
And maybe you really do have the better mousetrap at that point, so you can charge premium pricing for it. Some of the other things that you'll be interested in taking a look at, investors will take a look at too. The top two there are pretty key. It's the cost of acquiring customers and the lifetime value of customers. Acquisition cost, generally speaking, is your sales, marketing, and product cost divided by the number of new customers you have. So in a very simple example, if you spend $1,000 in marketing and that generates 2 new clients for you, you're basically at a $500 cost per customer. Now, is that good or bad? It depends on the industry because it may be really, really low or it may be really, really high. So you have to assess the costs that you're spending. Is it going to generate the revenue that you want to have? Then a customer lifetime value is more an assessment of what's your gross margin from this customer over the lifetime of the customer, if you plan to have the customer 2, 3, 4, or 5 years, compared to what it's cost you to get that customer. I think I've heard, again, it's going to depend on industry, it's going to depend on your business. Some people have suggested 3 to 1 is a good number, but there's no hard and fast rule in terms of customer lifetime value. The other one is cash flow break even, and when you're going through your statements and doing your forecast, you'll get a sense when you look at the bottom line number, if it's red or if it's black, if you're starting to cash flow. And that's something you want to track, obviously, very, very closely.
Yeah, and it's critical because when you are cash flow positive and you don't have to raise financing, you can be on your own timetable. When you're not, and you have that cash flow brick wall coming at you, and you've got 5 months, 4 months, 3 months before you're out of cash, it gives the investor all the leverage because they don't have to invest if they don't want to. So it can put you, the business, in a difficult position. Getting to cash flow break even gives you that timeline to be able to sustain.
Right, and also if you're looking at issuing equity in your company or convertible debt, you want to give away as little of the company as possible in the long term because you want to keep most of the value for yourself. And so, again, that's something that if you can break even from a cash flow standpoint, you'll have to give less of the company away to investors. I think it was on the slide before, then big red letters. Make sure that the balance sheet balances. Back to the original assets equal liabilities plus equity. If those numbers aren't the same when you get down to the total, then you have a problem in your model. And then also make sure that the data is flowing correctly between schedules. As Jerry pointed out, the net income number flows into the cash flow schedule. The cash at the bottom of the cash flow schedule is going to flow into your balance sheet. So all of those things are integrated and they all have to tie to make sure that you have a good forecast, a good model. And if those numbers aren't there, then you have to go back and obviously tweak what you're doing. Consistent use of cash or accrual accounting. We talked about this one before. I think that from an accounting standpoint, from a book standpoint, if you will, your forecasting, you really should be done on an accrual basis, which means that you will recognize receivables, you'll recognize payables, you recognize accrued expenses. And what do I mean by accrued expense? If you have payroll, for example, that you're accruing through the end of the year that won't be paid until next year, that's an accrued expense at the end of the year. And you want to recognize that in your model.
Some guiding principles just to help as you go through this. Accept reality. Everything, I'm talking about the business, everything takes longer than you think. Sales cycles are always longer. New products don't get ready on time, or they could have more debugging than you need. Fundraising can take longer. So make sure you plan for that eventually, that actuality. Things always end up costing more than you think. Those little costs add up. If you're just starting out and you don't have volumes, it's hard to get preferential treatment or get volume discounts from suppliers or get payment terms. I was involved in an import business where we were starting out, so if we needed to get our inventory product, we had to pay in advance to China for them to stick it on a boat for X number of weeks. And that's a huge cash flow burden. Really importantly, me being a business guy, Larry being an accounting guy, unless you have really, really, really good financial skills, you're going to need help. So that's why guys like me work with guys like him, and we create good partners that way, because the entrepreneur understands the business and has to really own the assumptions. But someone who's technically savvy like Larry is and knows how to work through spreadsheets and understands accounting inside and out and can keep you on track is really, really critical. And I think we touched on that before. Sometimes we'll see people present models or forecasts in its quarters or years. It's got to be monthly, especially for a business that's in a stress point, meaning it's young, it's starting out, it's vulnerable, it's still proving itself. Seeing that granularity is important to know. You can't run your business if you don't have that granularity, because otherwise you'll get surprised, because that one big account won't come in or that one big check won't end up in the mail, and then what do you do? So longer term, those projections are helpful because it gives an idea of the trajectory of the business. Do you think your business is going to go to $100 million in 5 years or $500,000 in 5 years, and why? So those things are also helpful to have, but they don't really help from an operating standpoint in terms of running your business. So after 24 months, it's pretty much just kind of a guess, but it is other than just showing the trajectory. So really just to wrap up. The spreadsheets themselves, Excel is a powerful tool, but they don't ensure quality. It's really, really easy to engineer outcomes that can look great. It's really easy to drag that cell across and just boom, 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 and wow, look at that, $1 million. Bears no relation to reality. So, and if you have a really good model, and I've had models for business I've operated on that were gargantuan spreadsheets with detail, one little mistake, one little minus versus a plus, one wrong formula that you skip through can massively take it out of whack, and it's really hard to find that. So you have to be really careful. You can sometimes I've had instances where I've just bumped the spreadsheet and hit a cell and hard-coded something that disrupted the flow of the formula, and it hit in the wrong place, can have tens or hundreds of thousands of dollars of impact on the whole model. Second, know your audience. Clearly, as you're projecting, you're creating your forecast. Yes, it's helpful as you build out your business, but you're going to use it as a sales tool. So when you're showing it to a banker, they're going to look at cash flow. They're going to look at trying to understand, are you going to sustainable? Are they going to be able to? Is your business going to be in a position to pay back the loan in a reasonable time and de-risk that? If you're looking for an investor, they're going to want to see a certain level of growth and a creation of value to make sure that they would want to own a piece of your business. If you're looking at your investors, they're going to want to know that you're in control of the business and that you've done your what-if scenarios and you understand what the risks are. Third point, as I started in the beginning, I always say, view it as the vital signs chart for your business. At some point, and having been an entrepreneur and having my own startups, you get to the point where these forecasts, you know them so well and you read them so well that they tell the story. And getting to that level of familiarity is really important, because then you're connecting the metrics with the ideas, and it really helps validate and quantify and help map that through. And we kind of beat the dead horse on that, but all the assumptions are hard. The calculations are easy. Excel and someone who knows how to wire it will get you there, but you got to make sure your business assumptions are tight. Strive for predictability, actual versus forecast. If you go back over time, and sometimes even in a diligence process, an investor may want to look at your old forecast and see how much you missed or hit by. So predictability creates confidence. So understanding and course correcting as you go through. So if your forecast went 10, 20, 30, 40, 50 each month, and you start on actually go 10, 10, 10, 10, 10, at some point you got to make some adjustments because you start losing credibility there. And challenge your assumptions. Ask yourself the tough questions. Don't be afraid to look at a scenario that's really ugly, because hopefully it doesn't happen, but better to think through what if than to be surprised. Resources, we talked about the key metrics. Larry talked about those. In terms of understanding what your particular sector looks like, a lot of that stuff can be found. If you're competing with a particular market where there are publicly traded companies, you can get annual reports, and there's a lot of details in their financial statements about assumptions that they look at and their ratios and so forth. Hoovers.com, which is part of Dun & Bradstreet, gives a lot of helpful information. Good old Google, and these days you can say, I want to see an example of a spreadsheet for a software company and blah, 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 and it'll probably just pull one right up. So you can dig through there and find samples of things. If you want to get to other subscription-based databases, public library, or if you can get through a university affiliation, things like Gartner or Fredonia give a lot of this kind of information of what sort of the norms are, what the trends are, how things are going, market sizing, current ratios on financials, and so forth. In terms of forecast tools, there are some. You know a little bit about PlanGuru. Have you used
I've
that
used
one?
it, yep.
And
There are
what's-
others.
And what's the take on that's a subscription-based thing, or?
Yeah, there is a fee for it, an annual fee, although you don't have to get the new one every year. And you can also do it in the cloud.
So network with other entrepreneurs, because everyone's kind of in the same boat, how they're building their models out. Get help from guys like Larry, who not only understand finance and understand being a CPA, but someone who's working with entrepreneurs and gets it. And I can say, full disclosure, he has helped advise my wife's business, the American Wine School, and helped her with all of her financials. 10,000 Small Business Program is another great program that can help provide basic tools and understanding of business dynamics and a way to work through. But fundamentally, the punchline though is that there's no substitute for spending the time and learning this stuff on your own and learning your own model, because understanding what your assumptions are, knowing how to work it, being comfortable moving things around is really the way to go, because that'll give you the most confidence and the most connection with these really, really critical metrics.
Let's thank Larry and Jerry for the first half of this presentation. Thank you very much. Appreciate it.